From the dot-com bubble to the 2008 financial crisis and the recent collapse of crypto exchanges, millions of retail traders have watched their life savings evaporate. They pour capital into the market, believing they are investing, only to realize too late that they were playing a highly leveraged game of chance. The mechanics behind these recurring losses were identified in 1949 by an economics professor named Benjamin Graham. In his text, The Intelligent Investor, Graham laid out a quantitative framework that would go on to shape the careers of his most famous disciple, Warren Buffett, and establish the entire school of value investing. Graham established a rigid boundary between investing and gambling. An operation is only an investment if it meets three exact conditions: thorough analysis of the underlying business, a mathematically calculated safety of principal, and the promise of an adequate return. If any one of those three pillars is missing, you are not investing. You are speculating. You are entering a casino where professional players have faster data, more capital, and decades of experience. To survive the market cycles that regularly wipe out retail traders, you must abandon speculation entirely. You have to adopt Graham's strict rules-based architecture for pricing financial reality. The foundational error most market participants make is assuming a stock's daily ticker price accurately reflects the intrinsic value of the actual business. This chart models Graham's solution to that error. The steady line is the intrinsic value of a business based on cash flow, while the erratic wave represents the daily price quoted by your theoretical business partner, a man named Mr. Market. Some days Mr. Market is euphoric, offering a massive premium for your share. Other days he is deeply depressed, willing to sell his stake for pennies on the dollar. You are never obligated to accept his quotes. You wait. You buy only when his pessimism drives prices far below the real cash value, and you sell when his euphoria drives prices far above it. This disconnect between price and reality is a documented historical constant. In 1938, fear drove the Great Atlantic and Pacific Tea Company's stock price so low, the market valued the entire corporation at just $126 million. Yet A&P had $134 million sitting in liquid cash and inventory alone. The market was pricing its physical assets at less than zero. In the short run, the market is a voting machine, driven entirely by popularity and emotion. In the long run, it is a weighing machine, measuring actual cash flows and assets. The intelligent investor profits simply by exploiting the difference between the two. But simply holding cash to wait out Mr. Market introduces a different threat. Inflation acts as an invisible tax, mathematically eroding the true purchasing power of idle capital year after year. While fixed-income bonds provide a guaranteed payout, that fixed dollar amount buys less in the real economy as consumer prices rise. Common stocks offer an inherent defense. Businesses can raise the prices of their goods to pass inflationary costs directly to the consumer, pulling their profits up with the tide. To balance these opposing forces of market volatility and inflation, Graham established a strict mechanical rule for the defensive investor, visualized here as a perfect equilibrium. Allocate exactly 50% of capital to high-grade bonds and 50% to common stocks. This structure requires maintenance. If a roaring bull market inflates the value of the stock allocation to 60% of the portfolio, the investor is required to sell the excess stocks and use the proceeds to buy bonds, forcefully restoring the 50-50 split. This automated mechanism removes human emotion from the equation. It forces you to trim positions when prices are high and buy when assets are cheap, without ever needing to predict where the economy is going next. For the stock half of that portfolio, the defensive investor must eliminate any asset carrying speculative risk. To do this, Graham engineered a rigid 7-point mathematical checklist. The first two constraints test for corporate resilience. The company must be large, generating at least $700 million in modern equivalent sales, and conservatively financed, meaning its current assets must be at least double its current liabilities. Next, the filter tests operational consistency. The business must show 10 consecutive years of positive earnings, a flawless 20-year record of uninterrupted dividend payments, and a minimum of 33% earnings growth over the last decade. Finally, the model caps the purchase price to prevent overpaying. The price-to-earnings ratio must not exceed 15, and the price-to-book ratio must be capped at 1.5. Applying these numerical constraints creates an absolute shield against lazy capital allocation and the danger of buying what's popular. It ensures the defensive portfolio is constructed entirely on documented financial reality. For those unwilling to accept market averages, Graham outlined a secondary path, the enterprising investor. This approach demands intense accounting research to uncover hidden market anomalies for superior returns. The instinct of most active traders is to hunt for fast-growing companies. But pricing a stock based on its future growth requires relying on highly unreliable predictions. If you pay a premium price today for earnings that might not exist tomorrow, you are taking on massive risk. Instead of projecting into the future, the enterprising investor looks for mispricings in the present. Graham's ultimate strategy was the hunt for net stocks, companies trading at a market price lower than their net working capital. By taking Graham's formula for intrinsic value, current earnings multiplied by 8.5, plus twice the expected annual growth rate, and working the algebra backwards, an investor can reverse engineer exactly how much growth the market has baked into the current stock price, immediately exposing irrational discrepancies. The enterprising strategy does not attempt to forecast the next tech boom. It systematically scans balance sheets to locate companies where physical, liquid assets are currently being priced by the crowd as if they were virtually free. The structural integrity of Graham's system relies on a principle called the margin of safety. It dictates that an investor only purchase an asset when its market price sits significantly below its calculated intrinsic value. Graham compared this to building a bridge. An engineer designs a structure capable of holding 50,000 pounds, but they signpost it with a 40,000-pound limit. That buffer absorbs the impact of heavy trucks, strong winds, and the unknown. This principle contradicts the standard academic dogma of finance. Modern portfolio theory argues that risk and reward are directly correlated, that generating higher returns inherently requires taking on greater danger. This chart plotting risk against reward visualizes Graham's proof of the exact opposite. If you buy a dollar's worth of assets for 60 cents, you secure a high reward with low risk. But if you find a mispriced dollar selling for 40 cents, your potential reward is much higher, and your actual risk is lower. A rigid margin of safety mathematically insulates your portfolio. It cushions against analytical errors, unpredictable macroeconomic shocks, and the irrational crowd. As a fractional owner of a business, you must remember that corporate management works for you. The clearest proof of ethical management is a consistent dividend policy, actively returning capital to the owners rather than hoarding cash for reckless corporate expansion. Graham defines a binary choice. An investor should be either entirely defensive, relying on mechanical rules, or entirely enterprising, committing to intensive research. The middle ground, exerting only moderate effort, generally leads to a combination of high trading costs and below-average performance. Securing satisfactory returns over a lifetime is relatively simple, requiring only basic arithmetic and discipline. But achieving superior results is extraordinarily difficult. It requires totally disconnecting your mind from the overwhelming psychological pressure of the herd. Wealth is ultimately a function of self-mastery. By applying a mathematical margin of safety and allowing the weighing machine to work over decades, an investor can isolate their capital from the irrational behavior of the crowd and build enduring financial security.